I'm Charlotte McLeod with the Investing News Network, and here today with me is Nick Santiago, Chief Market Strategist at InTheMoneyStocks. Thanks so much for being here with me today.
It's great to be with you. Thank you for having me.
Great. Now, since it's our first time talking, I wondered if you could give me just a brief rundown of your background and what you do at InTheMoneyStocks, particularly as it relates to precious metals, because that's what our audience likes to hear about.
Yeah, so I'm a trader, professional trader. I've been doing it pretty much for almost half my life now. Originally, I was a stockbroker in the 90s, but I gravitated more towards the trading side, and I started to use charts and technical analysis, and that really opened a whole new world for me. So once I delved into that, it really was just all about the charts and all about the mathematics and the mechanics and the money flow of markets, unlike being a stockbroker where it's about the story. It's about telling somebody the next great cure for cancer. I just morally couldn't do that. And once I started to learn really the dynamics about markets and about chart patterns and what really gets stocks moving, stocks are pushed by institutions. It's not the mom and pop at home that moves stocks. It's really the big money behind the institutions that push markets. So once I understood that and I started to really grasp it, I've never looked back, and I've been trading the technicals now for 25 years, and it's been an incredible journey, and I'm very, very blessed.
Okay, well, thank you so much for that explanation. We're speaking right now on August 6th. It's been a very exciting week for gold, which rose above 2,000 per ounce for the first time ever. I wondered if you could give me a sense of where you think we're at in the gold cycle. What do the charts tell you about the price right now?
Well, gold has had an amazing run, but a lot of people don't realize that, we had a very, very big sell-off in March when the stock markets crashed, and gold was basically on sale at that point in time. And with all the Federal Reserve and central bank intervention that's going on all over the world, everyone knows that who's going to be the sole benefiter is going to be gold. And gold has really soared, and so has silver. And now we've gotten above the 2,000 level, which is very psychological, because if you go back to September of 2011, I believe gold got to 1923 an ounce, and then it put in its 5-year bear market. But really what that was really just a bull run from 99 to 2011. Then you had a 5-year pullback, which is just a retrace. We never even got below $1,000 on gold, and now it's back above 2,000, making new highs. I think this is tip of the iceberg in the run, longer term. In the short run, we are very extended, very overbought. I would not be a buyer of gold here at this level. I'd wait for a pullback. It may go a little bit higher. We can't rule that out. When things go parabolic, they have a tendency to continue to fly. So it'll fly a little bit more without me. But I'll pick up gold again on another nice pullback or even a correction. And you will get that eventually. Nothing goes up in a straight line in the markets.
Okay. Now, when you look at a price chart for gold, what information are you using to come to the conclusions that you make? What details help you to understand what's next?
Well, first and foremost, for me, it's always looking at the trend. The underlying trend is obviously up, and that's easy to tell. All you have to do is look at and see if gold is above all of its moving averages. Is it moving from the lower left to the upper right? And when you see that, the trend is up. So gold is in a very, very strong uptrend, but currently it's gone parabolic, which means it's gone almost vertical. It's almost like a 90-degree move to the upside. So we know that's unsustainable. Hence, you'll get those parabolic moves like Tesla, and then they'll come back down. But all you have to do now is just wait for the chart pattern, a nice retrace. It could be a Fibonacci retrace, could be a Gann retrace. It could be something along those lines. It could be a consolidation pattern. We never know what kind of pattern is going to unveil itself. All we want to be able to do is really interpret the pattern when it unfolds. And gold right now has, put in a parabolic move, which is great. I mean, it's gotten above a lot of key levels, and that tells you that it's probably got another big leg ahead of it after a retrace or a pullback.
Okay, so people who are interested in gold, and there are a lot of new people coming into the market, have quite a few options when it comes to how they want to invest. They can go physical gold, they can buy an ETF, they can do stocks. Where are you seeing opportunity right now in terms of all the options that are out there for gold people?
Well, there are so many options, as you just mentioned, but if you are going to own, you have to realize, why do you even want to own gold, right? It doesn't pay a dividend. What's the real reason to own it? So for me, I've owned physical gold and silver bullion since the early 2000s, and I've never sold a single ounce. I look at that as my insurance policy. So if things really go horrible in the world one day, and God forbid we ever have to go back to a bartering system or something along those lines, people aren't going to really want my paper GLD. They're going to really say, hey, could I have a silver coin? Could I have a gold coin? Could I have a bar of bullion? That's what they're really going to look for. They're going to look for something tangible. They're not going to look for, okay, I think I'll take your share of GLD. They may not want that. So for trading purposes, yeah, I use the ETFs, the GDX, which is gold miners ETF, the GLD. I'll trade IAU, I'll trade SLV. You could also trade it via the futures market with contracts. But what I would always tell people, if you are looking at it in a way that I'm looking at it as saying, hey, if we continue at this pace to print money the way that these central bankers have printed it, you want to own some tangible physical metal. And in fact, I keep a little silver bar with me at all times just for good luck. Little 10-ounce silver piece there. So I just think it's very, very good to always have some exposure to the physical metal in your possession. And if you have a lot of it, you may want to store it somewhere else outside of your residence, but keep it in a safe place.
Okay, I think it's great advice and some great points there. I wanted to ask a little bit more about the gold stocks, because I know we have a lot of people who are interested in gold stocks. I wondered, when you're evaluating a stock, I guess it doesn't have to be a gold stock, from a technical standpoint, what are the positive signs you could see? What are the red flags? How do you look at that?
Well, right now they all have short-term red flags, because when they go parabolic, they're going to run out of room. There's only going to be so many buyers crowding into the space before you hit what we call an exhaustion point. And once you hit that exhaustion point, you're going to retrace. And why we retrace is there's always somebody. It's like a game of musical chairs. People always run around. You take one chair away, another chair away. Then somebody's left with no chair and they have to get out of the game. So that's what's happening in the short run. Longer term, though, I mean, there's probably not a better asset class to be in gold. So you watch the chart pattern, you watch what the moving averages are doing, you watch the overall structure that it makes. And there are a lot of different patterns in the market. And what patterns are they're basically footprints of human nature. So they're telling us what is going on. They're giving us an underlying story of the human psychology inside of that equity. And it really doesn't matter if it's gold or if it's a stock or if it's a home builder. It doesn't really make a difference. The same patterns seem to be repeating themselves over and over and over throughout history. I've studied just about every bull and bear market in almost every equity I could find. I have thousands of charts in my possession, and I just see these same patterns repeat over and over. So it's quite incredible when you think about it. But that's what you look for. You look for the underlying technical structures that are formed. And again, the charts are nothing more than footprints of human nature.
Okay, that makes it sound probably a lot more simple than it actually is, but that was great. I want to take a quick foray into silver as well, which you were mentioning before. Many people find it quite compelling. Silver, I believe it's still under $30 last time I checked, but it's been moving quickly. So I want to ask you what the next important levels are for silver right now.
Yeah, so silver just broke a big technical level at 26. So if you take a look at silver in April of 2011, what you'll notice is that silver went up to almost $50 an ounce in silver futures. And then they retraced all the way back down. Once we got through $26.30, we broke what we call a Fibonacci 382 retrace. And now silver sitting up here around $28 tells us that the next Fibonacci retrace is going to be around $30. And then if you just look at the silver gold 60 to 1 ratio, that tells you that silver ultimately should get back to around $34. Once and if it gets through there, I mean, the old highs of 2011 are game again at $50. So I like silver a lot better than I like gold right now, just because it's playing it's trying to catch up to gold. And that 60 to 1 ratio is usually where it will halt itself. And right now that brings you to around $34, $35.
Okay, that could be very exciting. And for people who want to get into silver, similarly, they do have a lot of options similar to gold, but I think there maybe are a little bit fewer options just because of there's less silver focused stocks out there. So how would you be playing silver right now?
So one of the ways I play silver is via the SLV. That's probably the easiest ETF to trade. Another way to get gold and silver exposure is to use the CEF. It used to be called the Central Fund out of Canada. Now it's called Sprott Physical Silver and Gold. And they actually keep, I believe, 90% of the physical metal on hand. So that's good to know. And God forbid, stock market isn't around one day and you need to claim your metals. You have a certificate to do that. So that's another way to do it. I own that in one of my retirement accounts, solely in one of my retirement accounts. I've never sold a single share of that. So that's another way to play it. Also, you have silver futures, which you can do if you want to do that. And another way that I played silver quite a bit is with SLV call options. So when I get a good pullback, I buy call options. I give myself a certain amount of time on the clock. I like to give myself at least 3 to 6 months. And so far, so good. When you're in an uptrend and you get those pullbacks, that seems to be a play that works out pretty well.
Okay. Now, you are not entirely focused on precious metals at all, although that's what we've been talking about right now. You cover a wide variety of markets. One thing I've continued to hear this year is that as precious metals prices rise, there's going to be more interest from generalist investors. And I wanted to know, with your wider perspective, would you say that's true?
I would say that's true. We're seeing right now a lot more new participants in everything, not only in the gold market or in the silver market, but you have the Robin Hood traders now. Ever since we had that March crash in the stock market, you have a whole new flood of people coming in. And that's what makes me a little bit nervous, because people think that the market trading is easy. It's anything but easy. This is the most humbling business ever. Every time it looks like it's easy, the rug gets pulled out from underneath you. So, but we're seeing a lot of new type of traders come in, a lot of new people. Right now, it seems to be a little bit on the easy side because the markets have gone straight up. But in fact, now we're in a little bit more of what we call the danger zone. You have to be a bit more careful here. But yeah, I would say that there, a flood of new type of investors coming on board.
And are you seeing opportunities elsewhere in the market? There must be something that's doing well aside from precious metals right now.
Well, what I try to do is I try to look at the areas that have been strong. So take, for instance, technology, which is the NASDAQ this year is up about 18%, where the other major indexes are, flat, and the Russell 2000 is actually negative. I like to look when money comes out of NASDAQ, if it goes somewhere else, does it flood into another industry group or another sector? So that's something that I like to look for. And when you can find those areas, then there's a lot of money to be made. I did isolate an area in the copper arena. So it wasn't just gold that was going up, but I saw that copper really put in a very, very bullish chart pattern on a large time frame. So I've been fortunate to make some money in some stocks like Rio Tinto, Freeport-McMoRan, Southern Copper, things like that. I just made some money in Alcoa, which is aluminum. So all of the base metals have been moving higher, especially as the dollar has been falling. And this is all on the fact that, central bankers are printing, money unlimited, it seems.
Okay. I think that gives us a really good idea of what's going on right now. I wondered, are there any final words you'd want to leave the audience with, any pieces of advice for investing during this time?
Yeah, you want to be very, very careful during this time. I know, we read these articles on television right now that investing has become easy. Stock markets only go up. I mean, if you were involved in this market in March, fortunately, I was short the market and I did well. But by the grace of God, I understood the chart patterns. These things are going to happen again. They're not over. I hope the bull lasts a lot longer because it's a lot easier to trade a bull market than it is a bear market. Bear markets are a lot faster to the downside than bull markets are to the upside. Hence, you could just see that we have not, in the S&P 500, we have not even made new highs yet. And, it's been basically 5 months since the March lows, or we're getting approaching that time period. Whereas, we tumbled in 30 days and went down, as much as we did from the February top to the March 23rd low in the S&P 500. So, don't take it for granted. This is not child's play. This is not easy. This is not an easy business. There's a lot of risk in this business. It's a dangerous business, and you really need to know what you're doing. Get educated on the charts, even if it's just understanding moving averages or just understanding price levels and very simple patterns. Just get started in that way. You'll be a lot better off going forward.
Okay, well, perfect. I think that's a good place to end. That's great advice for the listeners. Thank you so much for being here today. It was great to talk to you.
Oh, it was great being on. Thank you for having me.
Thank you so much. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Nick Santiago with In the Money Stocks.